This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
December 2010, F7 International, question 2 Cavan. Let's see what this is. Prepare the statement of comprehensive income for the year ended September 10. Statement of changes in equity, statement of financial position. Notes are not required. Okay, and we're given a trial balance and 5 notes. Okay. I tend to start at the last note, note 5. Provision for tax of 5.6 is required. Balance on current tax represents under or over provision of a tax liability. The tax base of the assets is 15 million less than their carrying amounts. The movement goes through the income statement. The income tax rate of Cavan is 25%. I've got 2 figures for tax in the trial balance. I've got a deferred tax liability of 4,000 and a current tax asset of 900. I'm going to do this in a T account. Some of you I know don't like T accounts, but I think from my point of view I find this the easiest way. I've got a brought down figure on the deferred tax account of 4,000. And I have a brought down figure on the on the current tax account of 900 asset. And we're told that we need a provision for tax of 5.6. So whatever happens, I want a brought down liability here of 5,600. And that's the current tax provision. In addition, the tax base of the Cavan's net assets is 15 million less than their carrying amounts. 25% of 15 million is 3,750, and that's what my carry down figure is going to be for the deferred tax account. 3,750. It was 4,000. It only needs to be 3,750, and I'm showing the liability for the current tax. There's the deferred tax liability, and that's it for the tax. I can balance off the account. That's 8, 9, 10,250, 10,250, 6,250 is therefore the income statement charge. And that's it for note 5. Note 4. The available for sale investments had a fair value of 13.5. There were no acquisitions nor disposals of these investments during the year to September 10. So they have a fair value of 13.5, and they're about halfway down the trial balance. Do you see just underneath accumulated depreciation? Available for sale investments, 15,800. So we've got a brought down figure of 15,800. We have a carry down figure of 13,005. We've therefore got a 2,300 loss or fall in value. And so we need to credit the available for sale investments. The question is, what are we going to debit? It needs to debit some part of equity. Well, it's not going to be debited to the shares account, nor the loan note, because that's not equity anyway. We're not going to debit it to retained earnings. Revaluation reserve, if we look lower down the question, point number 3 talks about revaluation surplus on land and buildings, so that's not where I'm going to put this figure of 2003. And it's not going to go to share premium account, which means it's going to go to the other equity reserve. It needs to be debited to some part of shareholders' funds, so I'm going to decrease other equity reserve by 2.3, and I'm going to decrease the available for sale investments by 2.3, and that deals with point number 4. Point number 3. Let's read this carefully. We revalue land and buildings at the end of each year. The relevant value to be incorporated is 41.8, so that gives us a figure straight away for land and buildings in the statement of financial position. But we're told the building's remaining life at the beginning of this year was 18, and we do not make an annual transfer from the revaluation reserve to retained earnings, which we really ought to. It's good practice to do so, but this question says we don't. Ignore deferred tax on the revaluation surplus. So let's have a look at land and buildings. And we're told in the trial balance that land and buildings at the start of this year, land was 7 and the building was 36. And it has a remaining useful life of 18 years. So I'm simply going to say that depreciation is 2, that's 36 divided by 18. We don't depreciate land, so there's our depreciated value for the land and buildings, and that's adding up to 41,000. But that's not what we want. We're told in the question that the figure is 41.8. So I have an 800 addition to give me that 41,800. So we have a revaluation credit to the revaluation account, and that depreciation is going to go to cost of sales. And that deals with paragraph 1 from point number 3. Paragraph 2, plant and equipment includes an item of plant. It was bought on the first day of this year. This 10,000 plant. It has a 10-year life, straight line depreciation, no residual value. It involves toxic chemicals causing decontamination costs to be incurred. So we need to make a provision for that decontamination costs. And the question normally is, where would you put the provision debit? The credit's obviously going to go to the provision account, but the debit would normally, when you make a provision, would normally go to the income statement. But if it's a provision for things like decontamination, then the debit entry should be capitalized into the plant and then depreciated over this 10-year life. The amount to capitalise is the present value, and the question tells us the present value of these costs at a discount rate of 10% is 4 million. And that discounted figure, the present value, should then be unrolled at the rate of 10% over the 10-year period. We've not provided any amount for this future decontamination cost, which we should do, and all of the plant and equipment is depreciated at 12.5% using the reducing balance method. Okay, let's have a look then at plant and equipment. PPE. But the question is 67,400. But we're told that 10 million of that is this toxic chemical producing plant, and therefore 57,400 is the other plant and machinery. And we're also told that the accumulated depreciation, because we're depreciating on a reducing balance basis, the depreciation is 13,004. So our ordinary plant has got a book value, a reduced balance of 44,000, and our new toxic chemical producing plant has a cost figure of 10,000. But we need to add on, so decontamination provision should have been, when this asset was acquired, should have been 4,000. It should have been capitalized at a figure of 14,000. And now we can calculate the depreciation for the year. Depreciation then for 2010 is 1,400, that's 10%, and 12.5% of that is 5,500. So we've got depreciation of 6,009, plus that depreciation from above, the buildings, and we have a book value of 12,006, an adjusted book value of 12,600, and 38,005, which gives me 51,100, and that's on statement of financial position as 51,500. And that deals with paragraph 3. Paragraph 2, the loan note. This is a strange one, isn't it? It was issued 2 years ago. We're at the end of 2010 now, and this was issued on 1st of October 08, so it's got 08 to 09, and now we're on this year, 09 to 2010. The loan note itself is, where is it? The loan note itself, the second figure on the trial balance. The loan note was issued for 30 million. But it's in the trial balance at 30,600,000. Don't panic about that, because it has an effective rate of interest of 10%, which is 3 million. But interest paid, if it hadn't been paid, it would have been carried at 33,000 or 33 million. Interest has been paid in the first year to 09 of 2,400. That's 8% of 30, and therefore it's carried in the figures that we're given at 30, and that's where the figure 30,600 in the trial balance comes from. And that's up to 09. What we've now got to do is do this year. So we've got 10% again this year, that's 3060, that's 33,660, and we have paid interest for 2010, that's been paid, of 2,400. So we've now got 31,260, and that's the loan note in the statement of financial position at 2010. And we've got interest, or a finance payment there, of 2,400, but we'll need to adjust that. That needs to be adjusted. That's the interest paid. This is the interest charge of 3,060. Right. I think that deals with that. We've got also, just let me pause a moment. We've got investment income, loan note interest. The correct figure is 3,060. And we've also got interest off. Okay. Now we've got bank interest as well, haven't we? We've got bank interest. Alright. Let's move on. Note 1. A fully subscribed rights issue. And this is on April 10. This is why dates are so important. This is on halfway through the year. One new share for every 4 at 42 cents. 42 cents, is that a discount? Oh no, the top line, the equity shares are 20 cents each. In fact, it's a premium. The company paid ordinary dividends of 3 cents a share and 5 cents a share in May after the issue. The dividend payments are included in administrative expenses in the trial balance. So we're going to have to work out the dividend. Dividends paid. This was a fully subscribed rights issue of 1 for 4. One new share for every 4. And we've got shares now, in dollar terms, 50,000. But those dollar terms are represented by shares of 20 cents each. So today there are 250,000 shares in issue, actual shares in issue. And that's today, the end of the year. But that's after the rights issue. So if it was a 1 for 4 rights issue, then the figure before must have been 200,000, and 1 for 4 applied to 200,000 will give me that 50,000 issued partway through the year. So brought forward must have been 200,000 shares. Now the dividends. 200,000 shares had a dividend before the rights issue, and the company paid 3 cents a share. That's $6,000. And now we've got 250,000 shares, and they've received a dividend of 5 cents per share. Well, 5 cents on that is, what's that, 12,500? So dividends paid at 18,500. And those have been included in admin expenses, and they shouldn't have been. It used to be that dividends appeared on the income statement. That's many years ago. 18,500 is an appropriation. It's part of statement of changes in equity. Appropriation. It's part of changes in equity. It's no longer an expense in the income statement. So we need to decrease. Where's it gone? Admin. We need to decrease admin expenses by 18,500, and we need to show in society, in the statement of changes in equity, this 18,500 coming out of retained earnings. Now we've also got something else to do with these shares. It's a little bit naughty, isn't it? We issued 50,000 shares, and at 42 cents. That 42 can be split down into 20 cents capital and 22 cents premium. This is just for interest actually, because you'll see in a moment that it doesn't actually concern us. 50,000 at 20 cents, that's 10,000, and 50,000 at 22 cents, that's 11,000. We actually received 21,000. Which is 50,000 shares at 42 cents. We actually received that, but if you look, you'll see the share premium account already has 11,000. And we've already been discussing, or already talked about just a moment ago, the fact that the equity shares started off as $40,000 worth, 200,000 shares. So that's already entered within the trial balance. It's already been correctly dealt with, but we will need both of those for statement of changes in equity. Have I dealt with everything? Point number 5, we've done the tax. Available for sale was 13.5 now, it was 15.8, so we've done that. No depreciation on any non-current asset. There are no other non-current assets, are there? No. Land and buildings, plant and equipment, no, we've done that. We did the 10 million and created the provision of 4, which we've now had to increase by a further unrolled discount. We've done the land and buildings, we've done the loan, we've done everything. So we're in a position now where we can do the statement of comprehensive income. I'm going to start it off as a statement of income and then build on to the bottom bits of comprehensive income. For the statement of income, and then also I'm going to add on the comprehensive income at the bottom. Revenue. Revenue 182,500. It's the big one. It will invariably be the big figure on the credit side of a trial balance. Revenue 182,500. Cost of sales needs adjusting, and you'll notice about halfway down, just below available for sale investments, you'll see inventory, closing inventory. Sometimes he doesn't do that. Sometimes he will tell you by way of note what the closing inventory was, and in that situation he won't give you a cost of sales figure, because the only way that closing inventory could appear in the trial balance is if we have already calculated cost of sales. Otherwise, he will give you inventory brought forward at September last year, and he'll give us a purchases figure instead of cost of sales. They're not the same thing. Anyway, cost of sales is 128,500. And we've also got some depreciation to put in that, isn't it? Just above point number 4, it says no depreciation has been charged. All depreciation is charged to cost of sales. Well, from memory, we had 2,000, didn't we? Do we have 2,000 up here? Cost of sales there, depreciation on the building. So we've got 2,000 on the building, 5,500 on the plant, and 1,400 on the toxic producing chemicals. So that's 7, 8,009, 137,004. 137,400. And that will then give me a gross profit figure of 45,100, and we're into the expenses. Expenses, down there, admin expenses. Oh, there was an adjustment. There was an adjustment to admin. That's 25,000 it was, and that includes the dividends. And the dividends we've calculated up here as 18,500. So minus 18,500. What's a big slice of admin expenses, isn't it? 6,500 left in the admin expenses. Distribution costs. Don't think there was any adjustment to that, was there? It's just 8,500. Then we've got the loan interest, the finance charges. Loan interest paid was 2004, but then we had that 660, wasn't it? Just let me check. The loan, the effective interest, 3060 should be. Well, we've already got 2,400. We've got that 2,400 in, so the 3060 is just the difference now then of, there's the 3060 there. That's 3060 interest. And we've got the bank interest of 300. Then is that it? That's 3060. And now we've got also the finance cost. The increase in the provision on this building. Let me go back up and explain that. You see this 400, this additional 400, this 10% of that 4,000. We're going to create a provision a year ago of 4,000, and now we have to unroll that provision at the rate of 10% a year. So that's 400, which we needed to add on to finance costs. So down we go, plus the 400. That adds up to what? 3060 plus 7, 3760 finance costs. And they've got some investment income, which I'm going to show separately. We've done the admin, the distribution, done the loan interest and the bank interest. So I can get to a situation here that's 14, 17, 18,007, 26,400, I think. And then we've got, am I right there? No, it can't, because I've got a 60 in there as well. 14, 15, 18,760, 18,760, 20, I think it's 26,340. Again, you check my additions. Then we got the tax. Now we worked the tax out. That was the first thing we did, wasn't it? We worked the tax out up here. Oh, where is it? Tax there. Income statement 6250. 6250, and that's in working. Well, it's actually working one, isn't it? The first working we did. That gives me 20,090. You know, I've forgotten the income, investment income. Investment income should go there, and I've forgotten it. I'll put it down below the tax, if you don't mind. It shouldn't be, it should be up here. But we've got investment income of 700. So that's 20,790. And I don't think I've forgotten anything else. That's ordinary. That's the ordinary profit after tax. Profit after tax. But now we've got the other comprehensive income. Because he asked specifically for just the one statement. He could have asked for two, statement of income, statement of comprehensive income. He could have asked for both, but he hasn't done. We've got an available for sale asset, and that's fallen by 2,300. Fall 2,300. So that's a bit of bad news. But we've also got a revaluation. Do you remember we revalued the revalued the building, and I put it under the building, but it could sensibly have gone in the land. It's there, the 800 revaluation credit. So that's also part of comprehensive income. And that was so 1,500 off that, 19,290. Don't think I've forgotten anything. No, I'm happy to leave it at that. 19,290. Okay. Statement of changes. Now the elements of equity are share capital, share premium, and we've got retained earnings, other equity reserve, and we've got a revaluation reserve as well. And I tend to put the total in, but I don't think it's desperately necessary. It should do, and in practice you would do. Brought forward figures, we've already worked out the share capital brought forward was 40,000, and there was no share premium brought forward. What about the retained earnings? Oh, he gives it to us, 12,100, up there towards the top of the trial balance. Other equity reserve is 3,000. And a revaluation reserve of 7,000. Just let me confirm that should be 7,000. So that's 10, 21, 61,100. Yeah? And then we've got this year's profits. Now this is at the bottom of the income statement, but it's excluding this comprehensive income. So this year's profits are 20,790. This year's profits are 20,790. But we've also had these comprehensive income changes. 2,300 goes into other equity, and 8,000 go into the revaluation reserve. So 2,300 negative, 800 positive, 1,500 negative total, and that's revaluation, revaluations and fall in value. And then we've got the dividends, because the dividends I mentioned earlier, these are an appropriation. I'm going to have to go, I'm sorry, but I'm going to have to go all the way back to find out what the dividends were, because I can't remember. That's not tax, other equity, land and buildings issued. There we are, I don't have to go all the way back at all. 18,500. 18,500. Dividends coming out of retained earnings and coming out of total equity. We've got this year's share issue. We've issued 10,000 worth of shares at a premium of 11,000. That's 21,000 additional equity. And I think that's it. I can't remember anything else. Let's see whether these figures make sense. That's okay, and that's okay, because those are both in the trial balance. 18,500, that's 2,290, 14,390. Do you agree? It's 14,390? I can't remember. 2,3,700 and 7,008. I'll add that across. 390, 1090, 890, 8, 22, 33, 83, 83, 890. I don't know. Add it down. Say 890, 390, 890. Negative 60, 80, 79, 69, 61, 71, ooh, maybe wrong. 890, 1000, 60, 80, 79, 71, 72. Have I added that up wrong? Have I added anything up wrong? It doesn't add up. 40, 52, 60, yes, that should be 62, 100. You're meant to be checking these additions. 62, 82, 81, 71, 63, 73, 83, 84, 83, 890. Okay. So that's the statement of changes. Into the statement of financial position. And we've got the normal things. Land and buildings for a start. Land and buildings. We've already worked it out up there. Land and buildings was... That's PP. Land and buildings 41.8. He gives us that in the question, doesn't he? And 51.1 for PPE. 41.8 and 51.1. 41.8 and 51.1. And that was PPE. Other assets available for sale. Got an available for sale asset. It was 15.8, and we're told in the question it's 13.5. Down at the bottom of the question there, it tells us it's 13.5. So that gives me tangible non-current assets with the available for sale 106,400. Yeah. And then we got the current assets. Inventory 19.8. Do I have any receivables? Yes, we do. Receivables 29,000. Bank. Now this is something that this examiner does invariably. He will normally put the bank balance as a liability. It's an overdraft. Just watch out for that. It comes up time and time and time again in exam questions that the bank figure is an overdraft. I don't think there are any other. No. So 48,800. There's 155,200. I have to say that doesn't ring any bells with me, but we'll have to see. Share capital, we know that, don't we? We know that's 50,000. Share premium, we know that that's 11,000. And then we've got, what have we got next? Retained earnings? Yeah, retained earnings 14,390. And then other equity and revaluation 707,008. Other equity and revaluation reserve. No non-controlling interest, not a consolidation. 70, 81, 82. 83,890. Long-term debt. Long-term liabilities. Well, we've got the deferred tax for a start. The deferred tax, we're told, is 25% of 15. 3750 we said, didn't we? We calculated that. 3750. Then we've got this provision on the contaminating toxic chemical producer. It was 4,000, or should have been 4,000, and now we've unrolled that, so it's 4,000 plus another 400. So the provision has got to be 4,400. And we've got a loan note. And the loan note is 30,600 brought forward plus 660 this year. We've already done a working on that, so I'm not going to go back up again. 31,260 is the loan note. And I think that's it for the long term. Let me just check through. Long-term debt, deferred tax, loan note, and we've created the provision, so that should be alright. So that's 39,410. 123,300. So you've just got the current liabilities. Current liabilities, payables, there they are, 21,700. 21,007. And we've got the tax, of course, and we're told that we needed a tax provision of 5.6, and the bank, don't forget the bank. The bank overdraft is 4,600, and should be it. That's 31,900, 31,009, 155,200. Does that agree? Yes, it does. And that is question 2. And the time is 17:53. We started this question at 19, 30, that's 34 minutes. I was going to say I can't see any mistakes, but it balances, which is always a good sign. If your balance sheet balances, it's a good sign. It doesn't necessarily mean it's right, but clearly it's got more chance of being right if it balances than if it doesn't. So that's question 2 from December 10. I should never have forgotten that investment income. That should have been shown up there. Should have been shown up there, actually, shouldn't it? I think I can forgive myself for that. Statement of changes, you really should familiarise yourself with the layout and the content of a statement of changes in equity, and beware, this figure for retained earnings is the figure at the bottom of the income statement. It's this figure, it's not this figure. It's the 20,760 from ordinary activities. This other comprehensive income is shown in order to show stakeholders what the overall improvement or change is in the company's activities, but is shown separately. These other comprehensive income items shown separately down here in the statement of changes. I don't know whether it will be absolutely necessary. You really should have a total column, but it's additional. You see, I made a mistake there, didn't I? Put 61,001. So if you don't have time, then you don't have time, but at least you're showing where these things fit into the overall financial statements. And that's one of the things that the examiner, both at this level and at P2 level, they both of them said at the conference in Nottingham earlier this year, that they want students to show an appreciation, an understanding of what's happening, rather than simply launch into workings because they've learned the workings. So an appreciation of an understanding and demonstration of an understanding is what they're looking for. All of these figures have got workings. That's got a working, so has that. So has that, actually. There was no working for either of those. Didn't need one. There's a working for shares and share premium. It'd be nice to cross-reference your workings, actually. Again, I don't think it's desperate that you cross-reference them, so long as your figures here are consistent with the workings higher up. We've got a working for that, and for that, and for that. We've got workings for all of those, and these two. Well, the working for those is in statement of changes, but the movement we have the workings for. And change for, we've got a working for that 5,006, in so much as I did a T account for the taxation earlier on. Anyway, that's it. Question 2.